So I've heard you say that before, and some other macro analysts as well, that idea of something breaking in the system. Can you kind of define what that means or offer an example? Like, what would break?
So two examples. One was late 2018 when we had that market sell-off with the Fed tightening. They were talking about being on autopilot. And then there's the famous Powell pivot where they stopped tightening. And that a lot of people thought it's because of the S&P 500 being down 20%, but really it's because credit markets froze. So no junk bonds were issued for 6 weeks in the United States. The whole market just froze. And that's a more serious problem than just stocks being down 20%. And so that kind of forced them to stop because it was basically the market became illiquid. And so they had to stop. And then less than a year later, in kind of autumn 2019, they had the repo rate spike. So they were still trying, they stopped raising rates. They were already cutting rates by that point, but they were still trying to tighten their balance sheet. They were shrinking their balance sheet, and they had to suddenly reverse course into quantitative easing because basically the banking system ran out of just excess liquidity. And so repo rates spiked. They had to come in and reliquify it, and that's an example of something breaking. So generally that refers to either a recession forming, or if it's financial markets specifically, it's credit markets, treasury markets, interbank lending markets, something like that just stops functioning and runs into a liquidity problem and seizes up. And then they're forced to basically reliquify it, even though inflation might be hotter than their target.
Are we technically in a bear market?
Well, bear market's generally defined as 20% downturn, which is arbitrary. So, but clearly we are. If you look at, especially under the surface of the indices, I mean, there are stocks down 50, 60, 70, 80, 90% in some cases. And then in addition, if you look at a 60-40 portfolio, like most of these other stock sell-offs in history came with bonds doing pretty well. But this one actually, bonds and stocks sold off together. So it actually hit people's kind of diversified holdings as much as a bigger stock sell-off normally would have. So I would say by most standards, yes, we're in a pretty significant bear market here.
In realistic terms, what's the best case scenario with what the Fed is trying to accomplish, and what's the worst case, but in realistic terms?
I think it depends on what timeline you're looking over. I think the best case is that you get kind of what happened after 2001, where you had the dot-com bubble collapse, and then you never really had a severe financial crisis. You just had a recession, and then you kind of continued from there. But I think situation's a lot worse than that now because of how much debt's in the system and because of where we are in the commodity cycle. So I think the more likely outcome is that this decade is going to spend a lot of its time being somewhat stagflationary, where commodity prices are persistently elevated. Now they can cool off for periods of time when we have economic contractions, but I think overall there's just not a lot of investment in oil, gas, copper, nickel, and then when you add geopolitical situations, some of the resources now cut off, or at least they're politically challenging to use now, and so we have to figure out other places to get those resources. And so I think that this whole decade is going to be kind of a struggle to keep getting the commodities we need, and that basically pressures commodities we need, and that basically pressures economies and inflation throughout the world.
Some people are predicting a melt-up because they say that the Fed always pivots, the Fed has to print. That's the conclusion everyone sort of has made based on history. Do you think that that's realistic to predict?
I mean, I think you can argue that the melt-up was the past couple years, because we had what in some ways was a very, very sharp recession due to the lockdowns and everything, and yet the market went straight up. And that's because of all the record amount of liquidity going into the market. And if you look at most charts, it looks like a melt-up. So you can argue that we've already seen a melt-up. Now, you could get another one if basically the Fed is forced to ease into an inflationary environment, and other central banks are doing the same. Essentially, what I would kind of point people to look at is what happens in emerging markets during recessions. Because often, if you look at what's happening in their stocks in local currency terms, they're going up because it's rather inflationary, and the unit of account is what's going down. But if you look at their stock market in dollar terms, it's really not great. Same thing is if you look at Turkey, for example, because inflation's so high, their stocks are actually doing pretty okay in lira terms. And so I think that if you see that kind of thing, maybe to a lesser extreme, happening in developed market currencies, you get kind of the same phenomenon where maybe stocks in nominal terms don't do terrible, but if you price them in something like gold, for example, the chart will look much worse. Or it's a basket of hard goods, maybe a basket of commodities. I think that they are going to perform poorly in that environment, but you can technically have a melt up in fiat currencies if you debase the unit enough.
It's interesting to hear everyone predicting the ultimate put and pivot, because at this point, how does the Fed have any credibility anymore? How do people even trust the system when, if they're going to turn around and just inject liquidity again and ease, then we just keep going up and inflate the bubble further? I mean, the show has to end at some point, right?
Well, I think that's why they're trying to tighten now so aggressively. I mean, this is the first 50 basis point rate hike in like 2 decades. And I think they're trying to regain some of their credibility. And I think that's why they're, even though we're clearly in a downturn by leading indicators, they're still kind of pushing it because it's kind of the last grasp to try to stabilize and try to have some ammo for their next easing. But yeah, I think we're kind of past the point where they have a lot of credibility. I think especially, even not just the Fed, if you look at, Bank of Japan is pegging long duration yields at 0.25%, so yield curve control. And then you have the ECB, which has a problem because different countries have different debt levels. And so, if they try to tighten, then some of the southern European countries, like Italy, with the amount of debt they have and no foreigners want to buy it, are in trouble. And then their spreads blow out. And so all the major central banks have pretty significant, credibility issues around their ability to tighten. Whereas, ironically, if you look at some of the emerging market central banks, Brazil's been tightening for the past year, and they're at double-digit rates because they're taking all the steps they need to try to rein in inflation and try to make their currency offer yield that's comparable to inflation, whereas it's the developed market central banks that have been really behind the curve because they're the ones that have so much debt.